Welcome to Breaking News to Trading Moves. When a stock violently breaks through a major ceiling, uh, every instinct just screams at you to buy before you miss out. But what if I told you that the safest looking candle on the chart is, well, actually a mathematically designed trap?
I mean, the speed of that movement is undeniably magnetic. It looks decisive. To anyone watching the tape, the sudden influx of volume just feels like absolute strength.
It projects strength, yes, but that projection is highly deceptive. It feels like the safest place to put your capital because the proof is flashing right there on the screen in real time.
Right.
But when you examine the actual mechanics of that initial breakout, the picture becomes incredibly complex. So today, we are evaluating the concept of the first breakout in technical trading, that exact moment when price pushes above a clear, established resistance level.
It really remains one of the most polarizing actions in market analysis. The central disagreement we are evaluating here is this. Is this initial breakout an emotional liquidity trap that requires trader to wait for controlled confirmation? Or is it a valid entry point where, frankly, waiting for certainty missing the real opportunity?
And I hold the position that the first breakout is primarily bait. It is engineered to pull in late buyers, making a structural retest and proven confirmation an absolute necessity for capital preservation.
And I take the opposing stance. While caution obviously has its place, over-prioritizing confirmation inherently makes a trade late. I argue that a well-planned entry on the first breakout is the optimal approach, and waiting for absolute certainty is a mathematical detriment to a trader's risk-to-reward ratio.
Well, let me state my case clearly regarding why I view that initial push with such intense skepticism. A resistance level breaking does not automatically equal a trend reversal.
Sure.
It simply means prices entered a historical supply zone, an area where traders previously encountered overwhelming selling pressure. You might look at that fast candle and see aggressive institutional buying. I see why you think that, but let me give you a different perspective. That first breakout is very often a trap, fueled almost entirely by the fear of missing out, combined with localized panic.
Panic? I think that's mischaracterizing it a bit.
It is panic, because that horizontal level is so universally obvious. It is exactly where concentrated stop losses and buy stops reside. When those orders trigger, they create a sudden burst of liquidity. Larger market participants, the ones who need massive volume to offload their positions without tanking the price, they sell directly into that burst. So what feels like the most confirmed, de-risked trade is actually the most emotionally compromised entry you can take.
I come at it from a different way. I acknowledge that the first breakout can trap unprepared retail traders. We have all seen a chart reverse immediately after clearing a high. However, systematically avoiding the first break entirely is equally damaging to a trading system.
Damaging?
Absolutely. The market is an environment that severely penalizes latecomers. Traders constantly seek certainty, but they forget that certainty is inherently expensive. By the time a breakout looks obvious, by the time it is fully confirmed, and the broader consensus agrees the trend has reversed, well, the cleanest entry is already gone. Your optimal risk-to-reward ratio evaporates while you wait on the sidelines for a textbook retest that, in the strongest market environments, may never actually materialize.
But you protect your capital.
The solution to the liquidity trap is not avoiding the first break. The solution is rigorous mechanical planning before the move even happens.
We need to examine the actual microstructure of that initial volume burst, because I believe this is where the illusion really takes hold of a trader's psychology. Let us look at what is actually happening in the order book when price hits that critical resistance line.
Okay, let's look at it.
The immediate assumption when you see a fast candle in sudden volume is that it represents aggressive, sustained demand entering the market. But mechanically, looking at the order flow, that is rarely the case. It's a lot like a sudden loud noise in an empty room, right? It creates a lot of immediate reactions, a lot of chaos, but it doesn't mean the physical structure of the room has altered.
You are referring to the execution cascade of automated orders rather than discretionary buying.
Exactly. Think about who is positioned at a major resistance level. You have short sellers who have placed their stop-loss orders just above the line to protect their capital. A stop-loss for a short position is, mechanically, a market buy order.
Right.
Then you have momentum traders who place buy-stop entry orders, hoping to catch the momentum the second the level clears. When price touches that exact technical level, all of those automated buy orders trigger simultaneously. Think of resistance like a tripwire. When price crosses it, it triggers a chain reaction. It is an artificial vacuum. You aren't seeing a stampede of new buyers, you are just seeing the tripwire going off.
A tripwire. Okay.
It is panic activity from shorts getting stopped out and reactive activity from momentum algorithms. Once those specific, trapped orders are filled, the artificial buying pressure just vanishes. The traps are sprung, the momentum dies, and the price rejects aggressively.
I will grant you that the initial burst is often just a tripwire snapping, but you are ignoring the aftermath. The noise of the trap doesn't dictate the structure of the market. The closing price does. This is exactly why traders must observe how the price behaves in the moments following that burst.
The close can be deceptive too.
But has price closed above the level or only spiked through it? If it is just a liquidity hunt clearing out short stops, the chart will leave a massive top rejection wick and aggressively retract back below the level. But a clean, sustained close above resistance proves institutional demand is actually absorbing the liquidity. The buyers are not just triggering stops, they are holding the new ground. If you dismiss every initial volume burst as a mere tripwire, you blind yourself to the times when real demand is genuinely absorbing the supply zone.
Well, the close doesn't guarantee structural demand either. The larger players who are distributing their positions need that exact artificial vacuum. They cannot sell 1 million shares into a quiet market without collapsing the bid. They need the frenzy.
Sure, they need liquidity.
They need that tripwire to go off so there are enough eager market buys to absorb their massive limit sell orders. The close of a 5-minute or even a daily candle might look strong simply because the distribution is orderly and managed, not because the buyers are actually in control of the tape.
That assumes every breakout is a covert distribution event. If we operate under the assumption that every push through a key level is an institution offloading bags, we would never take a long position. You are treating the footprint of the market as if it is always entirely deceptive. But order flow often tells the truth if you know how to read the cumulative volume.
If you can read it in real time, sure.
When you see persistent buying pressure, aggressive market orders lifting the offer consistently even after the initial stops are cleared, that is not a trap. That is a genuine alteration in the supply-demand imbalance.
But if identifying real demand versus a meticulously engineered distribution vacuum is that difficult in the heat of the moment, then entering on the initial break is purely a gamble. The only way to strip away the illusion of that fast candle is to enforce a strict timeline. You have to wait for the structural retest.
A strict timeline?
Yes, a robust, defensible trade requires a specific sequence. First, the price must break the level. Then, it must hold above it for a duration. Next, it needs to retest that specific area, turning old resistance into new support, and finally, continue upward with controlled momentum. That sequence is the only mathematical proof that sellers have failed to regain control. Without that sequence, you are just guessing at the intentions of the tape.
I'm sorry, but I just don't buy that. Let me tell you why that sequence is structurally flawed in a live market environment. You are demanding a textbook retest. The problem with textbook examples is that they assume the market is polite, accommodating, and willing to offer you a zero-stress entry. In reality, demanding that level of confirmation severely damages your mathematical expectancy.
I argue it protects your expectancy by filtering out the low-probability noise.
Let us ground this in hard numbers to see why the textbook retest is so expensive. Imagine a stock testing the $100 psychological level for the 4th time in a month. It is a clean horizontal resistance. The consolidation pattern underneath has built a logical base around $95. That $95 level is your structural invalidation point.
Okay, standard setup.
If you buy the initial aggressive break at $101, you are risking $6 to catch a measured move to perhaps $120. Your risk-to-reward ratio is better than 3-to-1. The math works perfectly.
It works perfectly on paper, assuming the setup actually succeeds.
Let me finish the scenario, because this is where the retest model falls apart. If you demand the break, the hold, and the retest, you do not buy at 101. You wait. The price pushes to 105, then slowly bleeds back to 102. You finally enter at 102.
Which is a much safer entry.
But your structural stop loss often must remain below the original consolidation at $95 to remain technically valid. Your risk has expanded from $6 to $7. Your target is still 120. The math has degraded. And worse, what if the structural stop is now considered too far away, so you arbitrarily tighten your stop to $99, right under the breakout level?
That happens frequently, yes.
Exactly. Now you are exposed to a routine volatility sweep that tags $98.50, stops you out for a loss, and then the stock marches to 120 without you. Waiting for the retest forces you into inferior trade management.
I'm not convinced by that line of reasoning because you are isolating a single winning scenario to justify a system that chronically exposes capital to low probability entries. Your math assumes the initial break is genuine, but let us look at the expectancy of the system over 1,000 trades.
Gladly.
If you do not wait for the structural retest, how do you mathematically distinguish between a genuine directional move and a sudden reversal before your risk is realized? If you buy at 101 and it was just a tripwire going off to clear out stops, the price does not go to 105 and pull back politely. It aggressively rejects, falls back into the range, and drops straight to 95. You take a full loss.
That is just part of the statistical distribution of outcomes.
But the retest is the vital filter that protects your capital from those traps. A 3-to-1 risk-to-reward ratio is utterly useless if the first breakout setup only yields a 20% win rate because you are constantly buying into liquidity hunts.
But the retest isn't a flawless filter. Half the time, the strongest breakouts, the ones that go on to make massive multi-week runs, they never retest at all. They just go. The fundamental valuation has changed, and institutions are not waiting around for retail traders to get on board at a discount. If you sit around waiting for a retest, you miss the absolute best performers in the market.
You miss some, sure.
You miss the best ones. The trades you end up catching are the sluggish ones that were weak enough to pull back in the first place. You are systematically filtering out the highest momentum trades and only allocating capital to the mediocre ones.
And I would counter that missing a high momentum trade is infinitely better than taking a full stop loss because you acted impulsively. Capital preservation has to trump the fear of missing out. The mathematics of drawing down your account on failed first breakouts are unforgiving. If you lose capital repeatedly on liquidity traps, the percentage gain required just to get back to break-even scales exponentially. It is an asymmetric penalty.
The penalty only exists if you are entering blindly, reacting to the visual stimulus of the candle rather than a predefined strategy. The tension here isn't truly between entering early at high risk versus entering late with poor reward. The real differentiator, the actual edge in this environment, is how a trader prepares before the breakout ever occurs. The edge is identifying when the first breakout is actionable confirmation versus when it is merely bait.
And how do you propose a trader makes that objective identification in real time, amidst the fastest moving, most chaotic candles on the chart? The visual feedback loop of a fast-moving tape is designed to override objective analysis.
By knowing exactly where their invalidation point is before the breakout ever happens. The trap relies entirely on traders reacting emotionally to speed.
Right.
If a trader has a defined plan, they evaluate the context prior to the break. They analyze the preceding trend. They calculate exactly where their stop loss will go using bracket orders. When the fast candle prints, they execute based on predetermined logic, not surprise. They remove the discretionary emotion entirely. If it reverses and hits their invalidation point, it is a calculated business expense managed within their strict risk parameters.
I agree that rigorous planning is vital to survival. But we have to look at the psychological reality of the humans interacting with this material. The setup itself, the visual of the first breakout, is perfectly designed to make traders abandon those exact plans.
You believe the speed of the tape completely overrides discipline?
I believe trading is inherently an exercise in human judgment, even for system-based traders. The visual temptation of that first break often bypasses logic entirely.
A trader can sit there with a meticulous plan, knowing their invalidation point, knowing they should perhaps wait for a slight intraday pullback, but then that candle erupts. The volume spikes. The screen flashes green.
It is intense, I'll admit.
Suddenly, they are entering not because the setup meets their strict criteria, but because they feel late. They buy the absolute top of the candle out of sheer panic that the market is leaving them behind. The market knows where the obvious pain points are. The fast candle at resistance is designed to create a sense of urgency. When a trader feels urgent, they bypass their own rules. The first breakout preys on human psychology in a way that planned invalidation points rarely survive.
That's a compelling argument. But have you considered that a truly defined plan accounts for this exact visual temptation? A disciplined professional is asking specific structural questions before they ever authorize the trade.
Such as?
Are they entering because the volume delta confirms the plan, or because they feel an emotional urgency? Is the order flow confirming institutional demand, or is it isolated panic activity? If the volume is completely disproportionate and the bid-ask spread is violently erratic, a prepared trader recognizes the trap and abstains. You are describing an undisciplined trader reacting to a fast market. But for a prepared professional, the first breakout is a structural opportunity to capture the purest momentum of a move before the rest of the market catches on. Automation and discipline separate the professional from the retail liquidity provider.
It is a profound challenge, balancing the desire for early entry against the absolute necessity of capital preservation. Evaluating the tape under that level of psychological pressure requires immense discipline. We have covered vital ground here today regarding how to interpret these volatile market moments.
We certainly have. We have examined the spectrum from extreme caution and filtering to calculated, immediate execution.
To summarize our positions, I maintain that the first breakout is overwhelmingly an emotional bait zone. It is driven by localized liquidity, trapped shorts, and panic buying. In my view, it requires a structured retest, a clear demonstration of buyers holding the line and absorbing supply to prove actual demand exists. Without that proof, a trader is stepping directly into a trap designed by larger market participants who need that exact liquidity to exit their own positions.
And I hold that while caution is necessary, systematically avoiding the first breakout severely damages risk-to-reward metrics and limits exposure to the strongest trends. Absolute certainty in the markets always arrives too late. The cleanest entries require acting precisely when the level breaks, provided it is backed by a rigid, predefined plan and managed risk. Over-confirming a trade is, very often, just another way of missing the trade entirely.
Despite our different mechanical approaches to the order book, there are absolute points of convergence in our perspectives. We both firmly agree that the market ultimately rewards systematic preparation over emotional reaction.
Without question, buying a breakout purely out of a fear of missing out, without a calculated invalidation point established beforehand, is a guaranteed trap. The market excels at transferring capital from the reactive to the prepared.
The complexity of chart analysis lies exactly in this tension. Evaluating volume, reading demand at critical resistance levels, and managing human psychology provides a continuous, evolving challenge for anyone navigating these markets.
It requires constant refinement of one's own system and, frankly, an honest assessment of one's own psychological triggers.
We will leave the final determination to the listener to decide their own approach to these critical entries. Just remember that moment. You are staring at the chart, the resistance is clear, and suddenly the tripwire snaps. The candle violently breaks the ceiling. In that fraction of a second, before you react, you must decide what you are truly looking at, a genuine opportunity or a carefully laid trap.
Thank you for joining us on this exploration of the first breakout.